So, good morning, everybody. Welcome to the Registered Valuers program once again. What day is it? Is this your first day of the program or day four?
So this is day 4.
Day four. All right, great.
Yes.
So I'm hoping that all of you are already familiar with each other. You know each other already. Have you started interacting with each other? It's very important to network as part of a batch, right? And it's a relatively compact batch of about 14-15 people, I guess. So have you all started interacting with each other? No, yes. Yeah, okay. Okay, great. All right, so I'll start with a very brief introduction about myself and then we'll talk about what we are going to discuss today. Interestingly, I'm going to be with you today, tomorrow, and the day after. So we will spend considerable time together as part of this batch. So my name is Vikash Goel. I'm a chartered and a CFA and hold a master's in finance and an MBA. Also a registered valuer. So I have about 13 years of experience. So I became a CA in 2007 and have worked with companies like PricewaterhouseCoopers, Ernst & Young, ICA, and now I'm practicing as a valuer. No voice? Sorry, no one's able to hear me?
Yeah, now.
Audible? Okay. So now, okay, all right. So so basically, I'm a chartered accountant with 13 years of experience. Worked with PwC, EY, ICA, and have been practicing as a valuer for the last couple of years now. So I was one of the first valuers, registered valuers in the country, and I come from Kolkata. So yes, was started my valuation practice fairly early, and of course, have some exposure around training and recruitment as well. So that's a very brief introduction about myself. We will talk about financial statements analysis. But before that, if you can tell me 5 quick things that you've learned in the last 3.5 days or 3+ days so far. You can unmute yourself or you can use the chat window, right? But 5 quick things that you've learned so far in this program. We'll start with Mr. Shushanta Chaudhary. Sir, you can unmute yourself and just talk about what have you learned. One thing that you have learned.
Is it in all or only in respect of valuation of shares?
No. In this program, last 3 days, whatever you have learned. Anyone learning points, sir?
Yeah, we have learned about the macroeconomics. Then some of the acts like SARFAESI Act and also IBC valuation rules.
Okay.
Registered valuers and valuation rules. And some of the shares.
So we'll take only 1 point, sir. Thank you very much. I will just randomly pick 5 people so that we understand what have we done. Mr. Vijay Soni, you want to talk? Anything that you've learned. So I don't want the topic. I want the learning point. So okay, for example, there are 3 approaches to valuation.
Right. We learned about practical approaches regarding valuations.
Okay, give me one approach, sir. One name of one approach.
Cost approach, income, and market approach.
Great. Thank you very much, sir. Mr. Ranjan Shenoy.
Yes, sir. So we are learning about Transfer of Property Act and Stamp Act.
Mm-hmm. Any one thing that you remember from Stamp Act?
Stamp Act are the basics, sir, about like when the stamp duty is applicable, what all type of properties is applicable, and the different rates. Those kind of things.
Mm-hmm. Okay. All right, we'll take that. Mr. Harmeet Bawa.
Yes, sir.
Any
About
one thing
Companies Act and Companies Act.
Any 1 point within Companies Act, sir. Companies Act is the topic. My question is, what have you learned?
Many things. SEBI and LODR and regulations.
Okay, what's the section under which you become a registered valuer? Under Companies Act.
247.
247. Correct, precisely. Thank you very much. All right. So we'll start off with today's session on this note, right? We will talk about finance and financial statements analysis. Now, this is a fairly easy topic. Of course, because all of you are finance professionals, right? But we will look at it from a valuation perspective. So I'll very briefly run through a presentation where we'll talk about some of the high school finance concepts, but then I will spend considerable time using an Excel file where we'll talk about a couple of Excel tips and how do you approach valuation, right? And what are the things that you keep in mind when you look at valuation. So you can see my presentation, right?
Yes, sir. It's visible.
So we'll talk about introduction to financial statements, key Excel cosmetics, interpretation of financial statements, and normalizing, right? So we'll briefly talk about these. Now, I'm sure everyone is familiar. What are the key components of financial statements? Okay. So we talk about balance sheet, statement of profit and loss, statement of changes in equity, cash flow statement, and notes to accounts. Now, this is one part which most people don't look at, but this is very, very important. Okay. And as valuers, it is extremely important for us to look at the notes to accounts also. All right. So basically, these are summary statements. I'm sure we don't have to talk too much about it. I'm sure everyone is familiar that when you look at valuation of companies, there may be two types of financial statements. One will be under Indian GAAP and one may be under Ind AS. Okay. And there may be a situation where you are doing the valuation of a company which is under Ind AS, but its subsidiary, it has got other subsidiaries which does its valuation under Indian GAAP. Okay. So you will have to keep those things in mind, because then the accounting policies and regulation, the entire gap changes basically, right? So you may have to do some normalization. So we'll look at that going forward. Basically, what is equity? Now, again, this whatever you see in this slide is extremely simple, but it is important because these definitions are important from an examination perspective, right? So how do you define equity? It is defined as the residual interest in the assets after deducting all the liabilities. So basically, equity is also known as shareholders' funds, net worth, or book value of the company, right? And may be calculated as either assets minus liabilities or capital plus reserves and surplus, right? Basically, that is equity. So this residual interest is an important word. We have to keep this in mind. Second, liabilities are organizations' legal debt or obligations, including future obligations towards third parties. Now, whenever we use the word third party, right? Third party includes employees. So again, from a very simple perspective, employees are also third parties, even if they are internal. So we don't say outsiders anymore. We use the term third parties. First party is the company, second party is the shareholders, and third parties are everyone else, right? Other than the shareholders. Finally, assets, something valuable that an entity owns, benefits from, or has use of in generating income. Now, as we go along, one of the challenges that you might face in the examination, of course, not in the practical life, but in the examination, is they pick up a question from any standard. So, for example, rental expense, rent paid, is it an operating expense or a non-operating expense? Operating expense, right? It's very, very intuitive. So now the problem is that the question only says rental expenses and operating or non-operating. Basically, it has got some options, and obviously you will choose it as an operating expense. However, there is a new standard which has come in around leases, right? And that standard uses the term rental, and in that case, rental expense is capitalized. It is not an operating expense. So now the question does not specify whether they are talking about leases or not. The question is simply picked up from one of the standards. Now you don't know whether they are asking this from a financial statements perspective or from Ind AS perspective, right? So that challenge will remain. So therefore, whenever you are reading, you will have to keep in mind that in some cases, the exact words have to be chosen. For example, when you're reading about ethics, right? Professional ethics. Now, professional ethics, some of the points are very, very simple, but then the choices that they give are very crucial at times, right? They're very close choices. So, I mean, you may be deceived by the choices that are given in the exam. So please keep that in mind. Similarly, that's the reason why I'm saying that when you look at these definitions, sometimes you have to look at these exact words. So something valuable that an entity owns, benefits from, or has use of in generating income. That is an asset definition. quickly talking about financial statements analysis. Now, of course, what is financial statement analysis? So it's the process of identifying financial strengths and weaknesses. Now, whenever we talk about financial statements, right, the analysis can be of two parts. We can talk about qualitative analysis and quantitative analysis. Okay. When we look at qualitative analysis, we talk about macroeconomic conditions, management of the company, business model, growth prospects, use of technology, dependencies on labor, business location, social factors, so all of these, right? And there can be innumerable factors that may contribute towards the analysis of the company. Now, when we say qualitative, we're talking about company analysis, not necessarily financial statements analysis. And of course, when we are talking about financial statements analysis on a quantitative side, we may look at the trend analysis, ratio analysis, common size statements, and a lot of other things. Okay. So in real life, when you do, so number one, you might have questioned on the qualitative side in terms of what are the factors that needs to be kept into mind when you are doing the valuation. So there you will talk about the business model, the competitive strengths and advantages, right? You might have to do a SWOT analysis and so on. By the way, before I move on, I would recommend everyone, each one of you, to continue looking at the IBBI website. Okay, IBBI website comes up with notifications almost on a daily basis. So as on 1st September, IBBI has come up with a notification which talks about disclaimers. What kind of disclaimers have to be given in the valuation report, right? And they have given illustrative disclaimers also, that these are examples of disclaimers that you can give. So in those cases, and in that notification, it also mentions that when you're looking at due diligence or exercising due care while doing the analysis or while doing the valuation, some of the things that you have to keep in mind. So you do a SWOT analysis, you do inquiries of the management, you check about the management's background, right? A lot of things have to be seen. So all these are basically qualitative factors, and then we have quantitative factors, which is what we are going to talk about today. So again, very briefly touching on macroeconomic factors. So how does inflation impact valuation? Does it have a positive impact on valuation? Does it have a negative impact on valuation? Both. Okay, so let's talk, sir. Mr. Sushant Chaudhary, sir. Yes, sir. Please unmute yourself. What is the impact of inflation on valuation? Sushant sir, please unmute yourself and let's talk.
Actually, it is based on the perspective of the buyer who is buying or who are going to do valuation.
Okay.
No, the inflation, if the inflation has the positive impact on the growth of the economy, then the valuation will go up. But finally, if the inflation has the negative impact, economy is not growing, then the valuation will be negative.
Correct. Okay. Yeah. And then I'm also looking at some comments in the chat window, and I hear that it reduces present value, higher inflation, higher discount rate, lower valuation, both negative. Right. Great. So this is how this discussion is very important. If we said that the inflation in the country has gone down to 2%, is it a good thing or a bad thing? It's a bad thing, right? So for everyone who said that inflation has a negative impact, see, even if the inflation is very low, it still has a negative impact, correct? On the other hand, if inflation goes up to 8%, is it a good thing or a bad thing? Once again, it's a bad thing, right? So what we as valuers have to understand is, if the inflation is very low, that means people's consumption power is not increasing. The prices of goods and services are not increasing. People's salary will not increase, right? And everything slows down. That's what is happening right now, right? We are getting into a depression, sort of. And even before Corona, even before COVID happened, India was facing a risk of depression because there was decline in the consumption or decline in the growth for 3 consecutive quarters. And it is said that if the economy declines for 3 consecutive quarters, then we say that we have gone into a depression. Okay, so that is one side. On the other side, if the inflation is very high, if it is going above 7%, 8% every year, then what happens? We don't look at the consumption side. Now we look at the production side, because if the inflation is going up, the cost of raw materials is going up, which is increasing the cost of production for the companies. Therefore, the prices increases, right? And therefore, the demand comes down. Okay, so it has a dual impact. So, but then there is no one who can say that what inflation is good. So, ideally speaking, for a country like India, right, anything between 4 and 6% is considered to be a reasonable range. If it goes below 4%, it's very bad. If it goes above 6.5%, again, it becomes very bad. So it has to be within a range. Are we okay with this? Yeah. So inflation is general rise in prices, increase in cost of raw materials, decrease in purchasing power, right? So it is controlled, and if the inflation is controlled and reasonable, consumers have more money and the economy benefits and grows. So it has to be controlled and reasonable. Okay. Next, what is the impact of interest rates? Let's talk about this. And this is very interesting and very important. What is the impact of interest rate on the valuation? Cost of capital increases. Okay. High rate, low value. Okay. Yes. Can someone explain it to me? Mr. Rohit Mehra, sir, you want to talk?
Yeah, so with higher interest rates, basically your cost of capital, the cost of debt increases, so your borrowing cost increases, and also it has an impact on the discounting rate as well. So,
Yeah. So when you're looking at a discounted cash flow, because the interest rate increases, the denominator increases, and therefore the value comes down, right?
Right.
In fact, does it have any impact on the numerator also?
Sorry?
Does it have any impact on the numerator also?
So yeah, your borrowings is there, right? So the cost of borrowing, the cost of debt increases.
No. So that is the denominators. When we are looking at the present value, we have cash flows divided by the cost of capital. So you're saying the cost of capital increases and therefore value comes down. Agreed. Does it have any impact on the numerator also?
Yeah, so depending on if you're calculating free cash flow to the equity,
yeah,
then that has an impact over there.
Correct, right? So see, once again, if the interest rate goes up, that means the company has to pay more interest. Therefore, the profitability comes down, the cash flows comes down. So while in case of inflation, there may be a positive or a negative impact. In case of interest, it is always going to be a negative impact. And in fact, it has a double impact. On one hand, your cash flows will come down, and on the other hand, your discount rate will also go up. So in both the cases, the value of the company will go down, right? In fact, one of the reasons, now again, I don't subscribe to this reason, but we've seen that the stock market has constantly been going up throughout the lockdown period, even when the companies have been shut, right? But one of the reasons why they say that the value has been increasing is because of interest rates, because interest rates have really gone down. And for companies who are fundamentally okay or fundamentally sound, their debt capacity has increased, right? So they are able to manage their cost, or they are able to be more leveraged as long as their fundamentals are okay, and therefore the value of the companies are going up. Okay, so interest rate is also a very important factor when you look at the valuation. And this, anyways, we will continue to talk about even tomorrow and probably even the day after. Okay. This is a very quick snapshot of how the interest rate works and how does it have an impact on the valuation and on the economy. So if the interest rate is low, then what happens? Business expansions. There is business expansion because the companies are able to take more loans. Because the business is expanding, there is more hiring and more salaries. Because there is more hiring and more salaries, it increases the consumer spending. So people are able to spend more, save more. What happens? The companies start chasing more profits. So this leads to a growing economy, right? But however, when this continues, the prices increases because the companies are chasing more profits and the demand for money increases. Finally, because the demand for money increases, it may lead to a higher interest rates, right? Now, when the interest rate goes beyond a level, then what happens? The money supply decreases. The cost of fund become more expensive. Because the cost of fund becomes more expensive, the profits reduce. And when the profits reduce, the consumer spending also decreases. So that leads to a slowing economy. And then, of course, it goes back into this cycle, right? So in the long run, this is how the interest rate cycle works. And as we all know, that interest rate is primarily the forte of the Reserve Bank of India. So Reserve Bank of India usually would try to see whether they are in a whether they can be into this range where they don't whether they can be into this range, right? So that they don't have to really increase the interest rates beyond the point, right? So they try to regulate the interest rates within a range always. Okay. Any questions so far? Are we okay with inflation and interest rates, right? And similarly, there can be other issues as well, and you can get questions in the exam around these areas. Okay. When you look at the quantitative analysis, now, have you heard of the term common size statement? How many of you know what is common size statement? Any idea what is common size statement? Yes, sir. Mr. Subramanyaswara.
Yeah, bringing all the items in the bringing all items in a P&L as a percentage of the revenue or a top line is common size.
Correct. Perfect, sir. Absolutely right. And this is going to be very, very helpful in your valuation analysis. What happens in case of common size statement, as sir just mentioned, is you take every item on the P&L as a percentage of revenue. So your revenue becomes 100, right? And whatever expenses are there, you take that as a percentage of revenue. So what happens in case of common size statement is, you know how much is the company spending on salaries as a percentage of revenue, how much is the company spending on cost of materials as a percentage of revenue, how much is the company spending on advertisement as a percentage of revenue, and so on. Okay. The other benefit of doing this is it helps you in forecasting. So tomorrow when you start preparing the projected financial statements, then you know that you have to forecast about the sales. You have to forecast the sales. But most items on the P&L, and not all, remember, but most items on the P&L will be as a function of revenue. Yes or no? So salary expenses, cost of materials, advertisement, other expenses, a lot of these expenses are as a percentage of revenue. So you prepare the common size statement and you see that, let's say, employee expenses is 25% of sales. So you can assume that this will be consistent, and as the sales increases, the company will keep on adding more employees or increasing their salaries. Same for advertisement, same for cost of materials, and so on. Of course, there will be some areas within the P&L which is not a function of revenue, like depreciation or interest rates. So those, even if you calculate, you don't have to use them for forecasting purposes. The other benefit of common size statement is it helps you compare two companies of unequal sizes. Yes or no? So for example, even if you're calculating a Xiaomi with Apple, right, both being into telephone businesses or mobile phone manufacturer, not manufacturers, but mobile companies, then you can still see how much money Apple is spending on advertisement as a percentage of revenue, and those can be used as benchmarks. So common size statement is very good for comparing companies, for projections, right, and for understanding how the company's efficiency is. In fact, you've heard the term net profit margin, right? Net profit margin is automatically calculated under common size statement. What is net profit margin? Net profit divided by sales or by revenue, correct? So that is also automatically calculated using the common size statement. So we'll do this in details when we are looking at the Excel, but for now I'm just discussing it through the slides. Okay. Similarly, in the balance sheet also, you take every item of the balance sheet as a percentage of total assets. We okay? Next is trend analysis. Now, what is trend analysis? You see what is the year-over-year increase, or what is the CAGR, compounded annual growth rate. So for example, last year your revenue was 100, this year your revenue is 110. So you know that your revenue has grown by 10%, right? And next year your revenue grows to 120. So again, once again, you know that revenue has grown up by about 8.5–9%, right? So that is year-over-year increase. Or you can also take the CAGR. Now, what is CAGR? Let's say the company's revenue in 2010 was 100. There has been a lot of fluctuation in the revenue of the company, but in 2020, it has reached to 300. Can you tell me what is the CAGR? What is compounded annual growth rate? What is the annualized growth rate of the company? Have a number? Or how would you calculate it? So this would be calculated as 300 divided by 100 to the power 1 by 10 minus 1. 11.6, correct, precisely. Thank you very much. So the CAGR is given by, as I was just saying, that you would take 300 divided by 100, and because this is for 10 years, you will take 1 by 10 minus 1. So you will get 0.1161. That is 11.6%. Okay. So this is how you can also look at these when there are too many fluctuations happening in the life of the company. So you, instead of taking the average growth, you simply take the annualized growth. So you started your career with 10 lakh rupees of salary, and now you've reached at 1 crore over a period of, let's say, 7 years, right? So what is your annualized growth rate? Even if you shift jobs, even if you got a big spurt in 1 year and had no increase in some other year. So this is how you can calculate the CAGR as well, right? So you can have trend analysis where you take the year over year or a quarter over quarter growth, or you can take the compounded annual growth rate. Okay. And finally, we have ratio analysis. So we'll talk about some of the ratios as we go along. Yeah, we will do it in Excel. We will definitely do it in Excel. So I don't want to shift screens multiple times. So right now I'm just discussing the basic concepts. Then we will switch off the PowerPoint presentation completely and only work on Excel so that we have full focus, right? Before that, let's take one small example. Mr. A started his business by establishing A Limited with a cash balance of rupees 10 lakhs, right? And you have the sales of the first 3 months. So 10, 30, 50 and 80. The purchase cost is 70% of sales. Other expenses is 10 lakhs per month, and applicable credit terms with respect to supplier is 30 days and customer is 60 days. Okay. Oh, I'll explain common size again. So common size is when you take every item on the profit and loss as a percentage of sales. Okay. Okay. I'll just go back to this. Let me just show it here only. So let's say your revenue is 1,000. Okay. Your salary is 200. Your cost of goods sold is 300. So what would you do in case of common size statement? Your common size statement here would be this becomes 100%. Okay. What is this? So 200 divided by 1,000. How much is this? 20%. This is 300 divided by 1,000. How much is this? This becomes 30%. So this is how you would calculate for every item on the P&L. Okay. Similarly, you will have profit. Let's say the profit is 500. So the profit percentage would be 500 divided by 1,000. That is 50%. Okay. Coming back to this example, is that okay, sir? Somebody asked me about common size. Mr. Yatin, are you okay now? Yeah. Okay, great. Thanks. So let us look at this example, and can you tell me how this works? What are your observations? What's the profit in the first 3 months? Okay, what is the purchase cost? How much is this? 21. How much is this? Help me with the maths, please.
35.
35.
56.
56. Okay. Then how much? Other expenses is 10, correct? So what's your profit?
9.
9.
5.
5. Okay. Sorry, are we okay? 5. Yep. Isn't this -1?
Yeah, it's -1.
Yeah.
Sorry, yes, -1.
Yeah. And how much is this?
14.
14. Right? So this is our profit. Let us look at the cash position. Can someone tell me the cash position? So in the first month, what is your receipts? 0.
0.
Second month? 0.
60%. So 60% of 50.
Where is 60%, sir? With respect to customer is 60 days, right?
2 days. 2 months. Sorry.
So here we'll get 30, correct? Yes or no?
Yes.
Assuming the sale is at the end of each month, right? Now, what is the other and no other inflow? What is the outflow? So purchase cost is 70% of sales, correct? And you have to pay this in 30 days. So this 21 will not be paid right now. This 21 will be paid here. Yes or no? This 35 will be paid here. Correct? Are you with me? Correct?
Yes.
Then we have some expenses also. This 10. So assuming that this is paid in the same month. Correct? So what happens? This becomes how much? -10. Correct? This is my cash flow. Yes or no? What happens to this? -31. And what happens to this? -15. What is this? -15. -15. Correct? And then I had my opening cash balance was 0 here. The closing was opening cash balance was 10. So closing was 0. This became 0. So this was -31. Cumulative cash flows is what I'm doing. And this become -31. So this becomes -46. Correct? I've gone right at the end of the screen, but is it visible to you, right?
Vikas, from where did we get this opening 10? Vikas, sir?
Started with a cash balance of 10 lakhs.
Okay. Thank you.
Are we okay with this? So now, simply, if you look at the profit and loss statement, the position looks very good, right? The profit is going up. Correct? It starts from here, sorry. But if you look at the cash flow statement, right? Now you will not be able to get this straight away. You will have to calculate this. You will have to assess this after doing sufficient analysis. And this is what is going to lead you towards a better interpretation of the financial statements. Yes or no? Make sense? Now, we've already done this, and I will share this Excel file with you so you will know how this works. Let's revise the case a little bit. The revenues remain the same. It starts with 10 lakhs of cash balance. Now we are in the second case. Okay. Starts with 10 lakhs. The revenues remain the same, 30, 50, 80. Purchase cost is 70% of sales. This remains the same. I have increased this to 30 lakhs instead of 10. And I have changed the credit terms. Okay. With respect to supplier, it is now 60 days. And with respect to customer, it is now nil. That means all the sales are in cash. It's a cash sale model. Whereas it is able to pay to its suppliers later. Right? What happens? Just in the interest of time. So revenue is 30, 50, 80. Right? Purchase cost is -21, 35, and 56. This remains the same. This has changed because it was 10 earlier. So now you have your profit is negative, negative, negative. But still, if you look at the profit graph, right? What is happening? The profit is increasing. Yes or no?
Yes.
Correct? Even if it is negative, but it is heading towards positive. On the other hand, if you look at the cash flow position, right? Since the entire money is receivable in cash, see, with respect to customers, it is nil. So therefore, you receive the same money in the same month. Yes or no? But your creditors are not demanding any money right now because you have got 2 months credit period with them. Okay. So this 21 gets paid in the third month now. Other expenses you are paying in the same month. Okay. So net cash flow becomes 0. Opening cash was 10. Closing cash balance becomes 10. This becomes your opening cash balance, right? Here your revenue was 50, inflow was 50, no expenses toward, no payments to the vendors. Cash other expenses is 30, so your cash balance becomes 20 positive. You increase another 10 with opening balance, your closing balance becomes 30. This becomes your opening balance next month. But your again net cash flows here becomes 29 because your sales has increased and you are still paying the old creditors right now. So your cash position becomes 59, right? What do you see here? The cash flows are increasing. Correct? Makes sense? Now, once again, I have just said this in the previous slide also. Some of these things will be visible only when you do a due diligence, you deep dive into the financial statements. And when you do that, you will be able to infer such things, right? We will take a case study today. When I said that we will go through the Excel file, so we'll go through Jubilant FoodWorks and we'll see how that company operates. Okay, purely based on public information. Going into some of the ratios, some of the common ratios that are, I mean, all of you are aware of these, and these are also coming in the exam. So you heard of gross profit margin. So simply this is gross profit divided by revenue from operations, right? Net profit margin, net profit divided by revenue from operations. Now, whenever we use the term net profit, right, we usually take PAT. Okay. Here. So this is simple. I'm not going into it. Just remember, whenever you hear the term margin, right, the denominator is revenue from operations, and the numerator is whatever margin you are calculating. Because we also call something, we also learn about something like contribution margin or EBITDA margin. So in every case, whenever you hear the term margin, the denominator would be revenue from operations, and the numerator is whatever margin you are calculating. So contribution margin, contribution by revenue, EBITDA margin, EBITDA by revenue, net profit margin, net profit by revenue, gross profit margin, gross profit by revenue, and so on. Okay. I'm sure everyone is aware of what is EPS also, right? Earnings per share. This is PAT divided by number of shares. We will always take diluted number of shares. So always consider diluted EPS, right? The basic EPS is practically of no relevance at all. Okay, even when you're doing the valuation, always consider the impact of diluted EPS. Price to earnings ratio, we will spend some time on this before we move on to Excel. Okay, now what is PE ratio? Can anyone explain what is price to earnings ratio?
It's
Price per
sorry. Yeah, go on.
Yes, Wani, go on.
Market price per share by EPS.
Yeah, it's basically market price per share by earning per share of the share equity share.
Correct. So that's how you calculate it. How do you interpret it?
Higher PE, this is general interpretation and not specific. Higher PE, higher expensive share, and lower PE, low expensive share. But it's just very generic.
Yeah, so that's very generic, and that's true. However, that if you're looking at a high PE ratio, then you are looking at an expensive stock, and if you're looking at a low PE ratio, you're looking at an inexpensive or a cheap stock. So again, we'll qualify that statement in the next slide. What else? So, Mr. Sudipto, you were saying something. Please go on.
Higher P ratio gives you the valuation more, higher side.
Okay. Yeah. Great. Correct. So that's around the same thing. Suhani, any idea?
Basically, this deals with what percentage of market share the shareholder is earning with respect to the earning of the company.
Correct. Okay. So the other way of explaining the PE ratio is how many times the EPS is the market price of the share.
Actually, high P ratio shows that the stock is overvalued.
That is the interpretation, sir. But then we will not stop at that. We will qualify that interpretation. Okay. So basically, price to earning ratio determines the price per share with the earnings per share, and it is used to assess the future earning potential. If a company's share price is 150 and the EPS is 25, then the P ratio is 6. So basically, investors would have to spend ₹6 for every generated rupee of annual earnings. Ye jo last line hai, this last line is important for you to understand. Okay, how many years EPS is the price of the company? How many times the EPS? So for every rupee of earnings per share, the investors would be willing to spend 6 rupees, right? In terms of the share value. That is one of the ways of interpretation of PE ratio. We'll go into the interpretation that all of you have been talking about right now. So it represents that the price that the investors is willing to pay against each rupee of earnings per share. It is a proxy for the number of characteristics of the firm, including risk and growth. So basically, when I was a student, I understood P ratio like this, that price to earnings ratio is a positive function of all the positive factors and a negative function of all the negative factors that affect the value of the company. What does that mean? Basically, see, you've heard of this efficient market hypothesis, right? You heard the term efficient market hypothesis. Basically, in an efficient market, all the information is factored into the price of the shares of the company. Okay, all the information is factored into the price of the company or price of shares. So therefore, everything that affects the value of the company is included in the PE ratio. Okay, so this is the other way we understand PE ratio. In fact, I had written a very large article on PE ratio some years ago, which explained the entire thing. And if some of you have access to my book, it is there in that book as well. For calculation of PE ratio, take the last 12 months EPS, not the last audited balance sheet, but 4 quarters. Okay. To take the recent PE ratio, whenever you have to calculate the trailing PE ratio or the last PE ratio, do not look at the annual report, but look at the last 4 quarters. Okay. Because every year the quarterly earnings are disclosed. So look at the last 4 quarters to get the trailing PE ratio. So trailing PE ratio is given by the current market price divided by the EPS of the last 4 quarters. Remember, we will look at the diluted EPS. Okay. And what is the leading PE ratio? Leading PE ratio is given by current market price divided by EPS of the last 4 quarters into 1 plus growth rate. Basically, what is the expected earning of the shares?
If any company is not listed in the stock exchange, then
there is no PE ratio of that company, sir.
Okay.
There is no PE ratio of that company.
Okay. So what is diluted earning per share? Can you explain once?
Okay. So let's say a company has issued compulsorily convertible debentures. Okay. If the company has issued compulsorily convertible debentures, that means these are debentures. This is the loan of the company. So the number of shares is, let's say, 100. But since these are compulsorily convertible debentures, right? These debentures will be convertible into equity shares. When these debentures will be converted into equity shares, the number of equity shares will increase. Okay. Right? Yeah. At the same time, currently, because these are debentures, the company is paying an interest.
Yes.
But when the debentures will be converted into equity, the debentures will not get paid any interest.
Yes.
So on one hand, your interest will come down, your profit will increase, right? And the profit will increase because of at least 2 things. One, the interest, the second, the tax benefit on interest. Okay. And on the other hand, your number of shares will also increase. Yes. Right? So what is diluted EPS? Let's say earlier your EPS was 10. After conversion, your EPS becomes 9. Then we call it diluted EPS. It is possible that after conversion, the EPS may become 11. Possible, because you don't know the terms of these conversion. So if it is 11, then it is not called diluted. Then the diluted and basic is same. Diluted EPS is only when your basic EPS is reduced by virtue of conversion of some of these shares. So it can happen because of debentures, it can happen because of preference shares, it can happen because of ESOPs, right? And a host of other things.
Okay, thank you.
But remember, if the company is planning to come up with an IPO, then we don't call it diluted EPS. Diluted EPS is See what happens. So you are a current shareholder of the company.
So
Okay.
in that case, that planning will not take into consideration, right? Only after IPO, the earning
Correct.
per share will be changed.
Yes, yes, yes. Okay. So please understand the importance of diluted EPS. If you are a current shareholder of the company, right? You and the company is reporting an EPS of rupees 10. So you believe that you have a share of 10 rupees of the profit of the company, but the company has already issued some convertible debentures to some other people who are not the current shareholders. But tomorrow their shares will be converted, they will become equity shareholders, and your profit share will get diluted right away. So you should be aware of what is the dilution impact. Every PNL, it is the requirement under statutory GAAP. Every PNL must report both basic as well as diluted EPS. Okay. Any financial statements you pick up, it will mention basic and diluted EPS. Diluted can be same or less than the basic EPS, not more than basic.
Excuse sir.
Yes, sir.
Actually, I want this one valuation from your side. We are going to list in the stock market, and we want do the valuation of our company. What should be the share price of our company per share?
Right.
So please give some example after finishing this.
Okay, sure. But so that's the whole valuation thing that will be required to be done, sir. Right? We'll talk about it.
I have a query.
Yes.
Is to arrive at the diluted share, earnings per share from the basic, only the preference shares and convertible debenture is to be considered. If there is a non-convertible, that need not be considered, no?
No. If it is non-convertible, then it is not going to be considered. See, there has to be a dilution. So what happens? Any dilutive shares or any dilutive instruments needs to be considered. You calculate the diluted EPS at the back end. Only if the profit is going, only if the EPS is going down, then you post it. Otherwise, you don't post it. You say basic and diluted is same.
So this would include ESOPs.
It will include ESOPs. Yes, definitely.
So even in case of a restructuring where the lenders are converting part of the debt to equity, there also this diluted EPS will come in play,
Yes,
right?
yes, it will. It will depend on the terms of the convertible debt that you have. Yes.
Can there be a case where EPS will exceed, diluted EPS will exceed existing EPS? Because ultimately, if the shares are converted, that will be reducing our EPS only.
No. It can also increase your EPS. See what happens. It is possible that the interest was very, very high.
Okay.
If the interest was very high, then what happens? Your profit will go up significantly because a big amount of expense is getting reduced, but your number of shares is going up only nominally. So therefore, it may be high. But then remember, in that case, when you report it, then you will not say that diluted is less. I mean, diluted is more. So if your calculation says that diluted EPS is 11, you don't report it as 11. You keep it at 10 only. So we follow the principle of conservatism there.
Okay. Actually, my question is that how many for calculation of diluted share, how much period we should consider?
Next 12 months, sir. Not more than that. Anything that is dilutive in the next 12 months, that only you will consider.
So it's a leading P ratio.
No, leading P ratio is separate, sir. Right now we are only discussing EPS. Leading P ratio is different.
Then it will be a leading EPS then, not a trailing.
No. So I think so. There is an accounting standard which talks about how much period you take. I think in my as far as I remember, it is 12 months. But we'll have to look at the accounting standard for that once again. Okay. So finally, coming back to the PE ratio. So again, remember that if it is now when we talk about the PE ratio, right? Let's say the Sensex PE ratio is currently 14. Okay. This is your market PE multiple. Okay. And let's say this is any particular industry's PE multiple also. If you're looking at a stock whose PE multiple is, let's say, up to 20, what do we say? And let's say on this side, it goes up to 10. All these are hypothetical numbers only. I am just taking a hypothetical example. Okay. This is your market PE multiple. Now you look at a stock whose PE multiple is 20. What do you infer out of this? Other
Either
thing constant.
Whether it is overpriced or it has some distinct features in its business that makes the market price it higher than the others.
Okay.
It's
Now
expensive.
Okay. All right. So see, let's try to understand. What if, and this becomes, let's say, 4. Again, all these are hypothetical numbers, but I'm just helping you look at the perception or perspective of PE multiple. If the company is slightly more than the market PE multiple or its own historical PE multiple, then we call it a high growth stock. This is a plus thing. Okay. We call it a high growth stock. That means the company is outperforming its peers and may be a good thing. Okay. But if the PE multiple goes to, let's say, 50 also or 100, then we say, no, this has become very expensive. Are you okay? Are you understanding my point? Right? Again, I'm saying other things remaining constant. It may be a very expensive stock. For example, there are some companies who have grown up 3 times in the last 2 months. One of them is Adani Group, right? Dixon Technologies. So I'm not a fan of stock market that way, but I can just think of some stocks. So Dixon Technologies is trading at a PE multiple of 110 right now, and it is still growing. The stock price is still growing, but it may be said that it has entered into an overbought position. It is very expensive stock right now. Okay. On the other hand, if the PE multiple is, let's say, 10, then what do we call it? We say, no, this doesn't look to be very nice, right? Because it is underperforming its peers. Underperforming its peers. On the other hand, if the stock becomes too low, it can be usually negative, sometimes positive, right? Usually negative. Why? Because it is a trash stock right now. This company has completely gone out of trend. It is just not performing at all, and it is a trash stock. Some cases the fundamentals are right, but the PE multiple has become very low. It will definitely tend towards the average PE multiple, and the stock price will become high. So here we call it a cheap stock. Okay. Are we clear on this? Yes. Remember, this is very generic that I have said. Very, very generic. Okay. It is a very complicated ratio to tame. You cannot tame the PE multiple at all. I'm just saying a very global understanding that a stock, you look at the company's historical PE multiple and see if it is trading at more than the historical PE multiple, that means it has got high growth. If it is way beyond that, that means it has become very expensive. It can fall anytime. Okay. So similarly, you look at a high growth stock or a cheap stock or a trash stock or a overbought stock. Are we okay with this? Clear? Any discussion? I just saw somebody posting DMart's PE multiple is 136. Yes, and it has been very high for a reasonable period. But look at the other companies in this same industry, right? For a company that trades at a very, very high PE multiple for a very long time, it may enter into an overbought position and it may fall. So if you've been holding a stock when its value was, when it was trading at, let's say, 20, 30, 40 PE multiple, and it is now 136, you're okay. But if a stock is trading at 136 times PE multiple and you want to invest into the stock now, it may be a wrong decision. Okay? It may be a wrong decision. Are we okay with this?
Yeah.
Remember, we will never apply PE multiple if the company is reporting a loss. You cannot, because then the value will become negative. And remember, the value of the company can never be negative. Why can the value of the company never be negative? Or value of the shares can never be negative? Why can the value of shares never be negative? Perfect, Ranjan sir. Thank you so much. Right? Limited liability. So even if the share value becomes negative, as a shareholder, we have limited liability. So our liability is limited to the extent of the share capital, and therefore it may become zero. It may be at par value, but it will never be negative. Okay. So if the company is reporting a loss, you do not apply the P multiple at all. Okay. Are we okay till this point? Last ratio, return on equity or return on capital employed. So remember, this is very simple, but it's very important. This is the ratio that doesn't let the MD sleep. Right? Why is this ratio very important? Can someone explain?
Basically, it accounts for profit to be distributed to equity shareholder. So they have invested in the company only to earn profit. If the company is not able to give good profit to shareholders, they won't be investing in the company.
Very good. So why would this not let the MD sleep?
The task of MD is to give profit to shareholders. So he is the sole responsible. What I think.
Right. So you will hear that there are a lot of companies who say that we don't track the markets. We don't care about what happens to the share price of our company. Right? They are talking about this ratio. They say that we don't care about the price to earnings multiple because price may be speculative. But this is not speculative. This is accounting. Right? So let's understand, like how just Swani mentioned, right? What happens in case of return on equity? As a shareholder, remember that shareholders are like very sensitive spouse. Okay, very sensitive spouse, girlfriend, boyfriend, husband, wife, जो भी हो, but बहुत sensitive होते हैं. So कैसे होते हैं? So they have certain expectations of the company. They say, I have invested my money into the company. I have bought the shares of the company, right? If the average ROE of any stock in the market is about 13%, let's say, simple example, hypothetical example, 13%, and you are not generating 13% return for me, why should I be with you? Right? So therefore, we always say that date the stocks, but don't marry the stocks. Stocks ke saath dating karo. Don't marry them. Right? If they are not treating you well, leave them. You don't have to stick around with them. Correct? So that's what investors believe. So if the company is not generating a minimum benchmark ROE, the shareholders will sell the stock and move out. Correct? What happens in that case? The share price will go down. And if the share price goes down, the managing directors or the management will not be rewarded well by the board or by the shareholders. In addition to that, let's say even if it is not a listed company, share price is relevant only for a listed company, right? But what about an unlisted company? The same things would apply to an unlisted company. If the shareholders do not get their return, they will force the board to distribute the entire profits as dividends. Yes or no? Yes. You have generated only 5% profit, right? I don't want to plow back that profit into your business. So whatever profits you have earned, you are not generating enough return. Give me the entire profit as dividend. And I will take this money, invest somewhere else. What happens? Then the cash flows of the company go out, right? The investment plans get shelved. The company does not have enough funds to plow it back into the business. And therefore, if the company does not generate sufficient ROE, return on equity, it's always a bad thing for the company. Remember, it will always depend from industry to industry. So some industries have a high ROE, some industries have a low ROE, but you have to follow the industry benchmark, and every company should do that. Are we okay? Chale? A slight variation of ROE is return on capital employed, where you take profit before interest and tax. Sorry, this is EBIT divided by equity plus long-term debt. What's the difference between ROE and ROCE? In case of capital employed, denominator, return on capital employed, the denominator includes long-term debt also. And in the numerator, you add back the interest basically, right? So return on capital employed is important when the company has leverage versus no leverage. Okay. So how much money the company has generated on the entire funds which has been deployed into the company. That is ROCE. Okay, we'll leave it at this and we'll go into the Excel file. Any questions so far? Any question, discussion? No? Okay. Can you see Jubilant FoodWorks version 4? Can you see Jubilant FoodWorks version 4? Yeah, okay, great. So now, as I said, that we will spend considerable time on Excel, and I will take you through some of the best practices within Excel, and even how to look at financial statements analysis from a numbers perspective. Okay. Before I go into the analysis part, let me briefly talk about the Excel part. Okay. Now, when you look at, by the way, how many of you have been doing valuation for some time? Kitne log valuation karte hain already? Mr. Satish, Mr. Subramanyeshwara, you're doing valuation already. The others have not done valuation, not professionally. Okay. Not professionally. Okay. So I'm assuming nobody has experience in valuation, right? You don't do valuation as of now, as such. This is your first encounter with valuation. Okay, great. So now, when you do valuation, some of the things that you have to keep in mind when you start the quantitative valuation part. First of all, you will have to, in most cases, you will have to populate the entire financial statements into Excel, right? So in most cases, you will get the financial statements in a PDF format because those will be audited. Sorry, even if you download it from MCA, most cases it will be audited only, right? So you populate into Excel. Now, I see a lot of cases where people make multiple sheets. So there is one sheet which is called an input sheet in which they will input the balance sheet. The other sheet will be profit and loss. The third sheet will be consolidated financial statements. Fourth sheet will be assumptions. Fifth sheet will be projections. Then we'll take a consolidated sheet and so on. So yeah, see, you do that, but you don't always have to do that, right? Unless you are doing like a 7 lakh rupees engagement where there is a huge calculation that you have to do, it's practically not required. In most cases, you can do with a single sheet. The advantage of a single sheet is, in these days, I mean, see, the number of columns in Excel is huge now, isn't it? It goes up to XFD, and then it goes up to, I think, how much? 10,48,576 rows are there. 10 lakh rows, right? So one sheet is capable of handling a lot of data. And it's always easier to navigate within the single sheet rather than multiple sheets. Okay. So what I do is I usually try to see if we can do the entire calculation in a single sheet. So it becomes easy to navigate. The formulation errors, the linking errors are less in those cases. Okay. So now let's say we've done this example, taken this example of Jubilant FoodWorks, and we've taken this till 2019. I have not done 2020 numbers yet. Okay. But we've done it till 2019. So 2015, 16, 17, 18, and 19. And let's say we started with any company for that matter. Now, when you populate the numbers in Excel, you see some gray cells and a yellow cell. Yes or no? Yeah. What are these yellow cells? These yellow cells are basically formulated cells. And gray cells are input cells. Okay. Why do we need to do that? The reason we need to do that is, now see, when I'm populating these numbers, you may do it yourself or your team may do it. Anybody can do it, right? But and when you're looking at the when you look at the PDF, this number would be given in the PDF. This highlighted cell, for example, equity. This would be given in the PDF itself. So why am I asking you to formulate it? The reason why I'm asking you to formulate it is because you will be handling a lot of data in Excel. And when you're handling a lot of data, let's say this number was not formulated. Okay? Let's say this number was not formulated. I just removed the formula from this cell. And instead of 174, it was 147. I typed incorrectly. Right? Will I get to know whether I have made a mistake? I will not get to know if I have made a mistake. Yes or no? Correct? There is a mistake, but then it is not apparent right now. In fact, I have put a check here which says total assets minus total liabilities, right? But because I have made a mistake here and this number is not formulated, I am not able to discover the mistake. Correct? So therefore, what we always advise, sorry, what we always advise is that this was 174 and this should have been formulated. Okay, are we clear with this? Number one. Number two, let me give you a quick Excel tip. Okay, once you are doing the valuation, once you are populating all the numbers in Excel, right, sometimes you will simply just put the formula, right? So let's say these numbers were not formulated, not color coded. Now there is so much of data out there, correct? And this also has a formula. This does not have a formula. You can't make out unless you look in the formula bar, correct? Is there a way to identify? Now, what happens if you accidentally remove the formula? Jaldi mein formula hata diya. So what will you do? Again, you will get stuck because again you'll be dealing with a lot of data, right? So there is a quick way to identify all the formulated cells at the same time. One method is this. In the formulas bar, you click on show formula. Okay, and what it does is it expands all the cells within the Excel. Okay, right? And you can go to these cells, look at the formula, and also color code them. Let's say I'm doing a green color now. So all the formulated cells, I put a green color. But again, this is too much of effort, isn't it? I will have to look at the entire sheet. I will have to check all the formula and manually color code it. I don't want to spend so much time. Okay. So what I do instead is, this is how it is right now, right? So these are some formulated cells which are orange, some are now green, some are blank. So there is an easy way. You just press F5. You can see the go to dialog box, right? Click on special, go to formulas. Okay. And click on OK. What you will find is all the formulated cells are now selected automatically. And you just select a color that you want to apply to them. Let me put a different color. Whatever. Let me put a green color. Here you go. See. So now in your Excel, every cell that has a formula, every cell that has an equal to sign, that has a formula, becomes color coded. Good tip. Is this a good tip? Yeah. Okay. Did anyone know of this before? Did anyone know about this before? No? No? Yes? Okay, Mr. Anil knew about it. Okay, yeah, great. All right, perfect. Thank you very much. So now, there's a couple of Excel tips. One more is, I'll talk about one more. So if you look at the formulas tab and you look at the formulas bar, right? So you can actually check for formula in every cell. You can check precedents. Okay. So this way you will know, you can look at the precedents, and more importantly, you can also look at the dependents. Now, what does that mean? Let's say I simply delete this row. I feel that this row is not important. Okay. What happened when I deleted the row? See, I'm getting ref here now. Can you see the ref? And if I have not seen this immediately, I will never be able to make out that I have deleted some rows or deleted some cells, and that has led to the change in formula. Because see, Here, it will simply show plus if there was something, and Excel doesn't know what it was. Okay? Excel doesn't know what it was. So if you've not discovered this immediately, you will not realize that you have just deleted some cell, and because of which this problem has occurred. And this will happen. Let me tell you, friends, this will definitely happen. A lot of time what happens, the companies give you data in an extracted format. So they will just pick up one sheet and give it to you. Okay? Now that sheet had some other formula, they have deleted some cells, and all you get is ref, and you don't know where to track those cells. So therefore, instead, what you should do is, before you are deleting anything, check if there is any dependent of this cell or not. We may select some light color. You mean I should change this color because it's not visible to you?
Exactly.
Okay, sure. I'll just, this was just as an example. So I will change it. No problem. Yeah, is this okay now? You have a very light blue color. So again, that was just a feature that I was trying to show you. As long as you can see the numbers, it's fine now. Okay, and these will not be colored. These don't have colors. Okay. So all I was trying to say here is, before you delete any row or column, always check if these rows have any dependents or not. Okay. So go to the formulas bar and click on trace dependents. So you know that this cell is going here. Therefore, what is the likely impact of this cell is something that you should be able to understand. Are we okay? Can we move on? Yeah. So let's say we've populated all the numbers. So what are the key things that we've spoken about? Number one, keep as many cells formulated as you can. B, color code the formulated cells, differentiate the formulated with the non-formulated cells so you know when you want to make any adjustments, any changes or not. Third, there are tips, there are faster ways of doing it. Fourth, use the trace precedence, trace dependence feature to identify whether you should delete a number or where the numbers are coming from, and so on. Okay. So we've populated the balance sheet, right? We've populated the assets, the liabilities, and all of that. And we've also kept a check just to see whether my assets and liabilities are matching or not. Okay. So they are done. Now I was talking about the common size statement. So here is what we have, the common size statement. So you were saying, can we do it in Excel? So this is how you would do it. Okay. So I have revenue from operations, other revenue, other income, we get total income, right? So this is how you would okay. So every item on the P&L is taken as a percentage of revenue. Okay. With this, what we get to understand is the company spends 22% of cost of raw materials consumed on 22% of revenue is spent on cost of raw materials. 4% is purchase of traded goods. 0% is inventory, right? 21% of revenue is spent on the salaries. And if you see, this is consistent over the years, right? For Jubilant FoodWorks between 2015 and 2019. Similarly, even this one is consistent over the years. Okay. So this means the company has been performing reasonably well in terms of managing its costs, even if the revenues have gone up, right? So what is the revenue? See, if you look at the revenue, it has 16.2% YOY revenue increase, 5.6%. It went down in 2017. 2018, it was 17% increase. 2019, it was 18.5% increase. So the year-over-year increase in revenue is gradually increasing in case of Jubilant FoodWorks, except for 2017. And this year was a landmark year in Jubilant we'll see how. Landmark not in a positive way, but in a negative way. So you see the revenues fell. The increase in revenue fell from 16% to 5.6% in 2017. Are we okay? So similarly, we will do the common size statement and year-over-year increase for all the companies, for all the years of this company. Are we okay till this point? Yeah. And I don't have to explain how you would do it. You can simply current year divided by previous year minus 1 and put it in a percentage format. And that gives you the year-over-year increase in revenue. Okay. So you've populated the revenues or the income statement also. You've populated the balance sheet also, right? And see here we have basic and diluted. So dilutive can never be more than the basic EPS. It will be same or it will be less. Okay. Now, once you've done this, let us calculate some very basic formula. Some of them are very simple and intuitive. Some are important. You may not have heard of them before as to why we need to do it. So everyone is familiar with gross profit. Gross profit is calculated as total gross profit divided by revenue from operations. So how do we look at gross profits? So we look at gross profit is revenue minus these three expenses. Why have we taken these three expenses? Can someone explain why are we not taking total revenue? Why are we only taking revenue from operations? And why have we taken these three expenses to calculate gross profit?
The revenue indicates the performance. Other income does not have much relevance with the performance. So here we are going to measure the performance, in fact, operational performance. So we have to take the operational income and the operational expenses, or the expenses directly. In case of GP, we take the cost which is directly related to the operations.
Correct.
Not the work.
Thank you very much, sir. And for these three expenses, can someone explain what are these three expenses?
This is basically cost of goods sold.
Mm-hmm. So, sir, I understand this is cost of goods sold, right? Cost of raw materials consumed.
Yeah.
Now we all know cost of raw material consumed is given by opening stock plus purchases minus closing stock, isn't it?
Yeah. Yeah.
So that is already given. So why do we again have purchase of traded goods and changes in stock? Isn't this double counting?
No, I think they are also in the trading business. Some goods they are buying and some goods they are selling. So that purchase of traded goods has to be also included. Those part is the portion of the raw materials part which they have converted into finished goods. Some finished goods they might have directly purchased also. So that purchase has to be, because this has been sales of those products has been also included in the operational revenue. No?
Bang on, sir. Thank you so much. I'm very happy. Right? So is everyone okay with this? See, a lot of time people get confused about what is this item. So either they take only the first line, which is cost of raw materials consumed, or they think there is something wrong here. So as Sushanta sir just explained, see, think of what is Jubilant Foodworks into? What is its main business?
McDonald's.
Pizza.
Pizza. Domino's Pizza.
Burgers.
Jubilant Foodworks operates Domino's Pizza in India.
Oh.
Right? So, and when you think of Domino's Pizza, primarily Domino's Pizza, there's Dunkin' Donuts also, there's one more brand that they've just started, but primarily it is Domino's Pizza, right? So what happens in case of raw materials? All the ingredients, right? Dough, the flour, the dough, the vegetables, the chicken, and all of those are basically raw materials, which are then converted and sold as final product. On the other hand, you have got cold drinks, which is basically just traded, correct? So the first part is raw materials consumed, which is all the ingredients. And second is purchase of traded goods and changes of inventory in traded goods. Okay. So these three things put together would give you the gross profit. Okay. Now,
so revenue is gross revenue or is it net revenue?
Revenue will always be net revenue, right? We never talk about gross revenue anymore. Okay. It is always net revenue. Okay. But yeah, we are not taking other income here. So what's the difference between gross revenue, net revenue, and total revenue? So gross revenue is, let's say, including GST. Net revenue is excluding GST. Other revenue is, let's say, your rental income or your investment, interest, dividend, etc. Right? But here, when we look at the gross profit, we only look at revenue from operations. We don't look at other income. Okay? Yes, sir?
Actually, gross revenue is the total sales, and if you reduce the kind of sale return, so you should net sales.
Yes. So net revenue is other than GST and other than net returns. Correct. Sales returns. So with this, we calculate the gross profit. Okay. We also calculate EBITDA. How do we calculate EBITDA? Let's see. So in case of EBITDA, you start with profit before tax. So again, what is EBITDA basically? Earnings before interest, tax, depreciation, and amortization. Now, EBITDA is not reported in the statutory financial statements. The Indian GAAP or Ind AS does not require the companies to report EBITDA. They also don't require to report the gross profit also, right? But they are always required to report profit before tax. So with profit before tax, you simply add back any interest if the company is paying and depreciation and amortization because tax is already taken into account. Okay. So what is EBITDA? Earnings before interest, tax, depreciation, and amortization. Okay. In this case, the company does not have any interest payments. So therefore, interest need not be added back, and only profit before tax, you add back depreciation and amortization. Are we okay? What does EBITDA infer? EBITDA refers to operating profits of the company. Only the operating profits. Okay. So you calculate EBITDA for every year, and if you see the EBITDA levels are growing like anything, except for 2017, like I said, from 27 to 29, it took a dip in 2017, again went up to 46, and yet again went up to 64. Right? All these are in lakhs. Okay. The gross profit is also increasing consistently. Then you also take marginal tax rate. It's important to calculate marginal tax rate. This is total tax expense divided by profit before tax. So what is the effective tax rate that the company is paying? Okay. Now, either you can take the tax rate as per income tax slab. So you take the MAT impact, you take the tax rate impact and so on, or you can take simply the marginal tax rate, which is calculated through the financial statements. Okay. So this comes currently, it stands at around 34-35% for most companies. It can be anywhere between 33 and 37%. Okay, currently this was 28% in 2015 for them. Now this is very interesting. Working capital. Everyone understands what is working capital, right? Yes or no? Everyone understands what is working capital. Working capital is simply given by current assets minus current liabilities. Correct? So let us see. You see working capital. Now, when we talk about working capital, is a negative working capital a good thing or a bad thing? What does working capital imply? What does it mean? Bad. Okay. Always bad. More liability. Okay. Good. So Rohit is saying good. Okay. Are we able to meet our short-term obligation from short-term assets? Correct. Yep. Now see, that's how we, so this is the classic example where you differentiate between what is there in theory and what is there in practice. Okay. Let us look at this. So one, we see working capital is negative here. How is it calculated? Simply you look at the total current assets minus total current liabilities. So total current liabilities is 33,707 and current assets is 18,289, and therefore your working capital is negative. Okay. It was negative. It became even more negative. 2018, it became positive, and 2019 it became positive in a big way. So we have seen a big shift in the working capital position of this company, right? We can see that. Next, now let us try to evaluate this working capital. Okay, so what is there in working capital? We see In case of working capital, we have current investments, inventory, trade receivables, cash and bank balance, and other current assets. Right? Now, if you look at the cash and bank balances, 3,000. Is this a good number or a bad number given the revenues of the company? Or given the let's look at the current liabilities also first. Sorry. Look at the trade payables. This is all trade payables together. 23,950. Other payables 474. Other financial liabilities 1405. Short-term provisions 1403. Other current liabilities 6401. So we see that there is a huge amount of trade payables in the company. A huge amount of trade payables in the company, whereas the receivables is not enough. And of course, the other current assets are not enough. So it appears that the company will struggle to pay off its current liabilities. Yes or no? Are we all together on this? There is a huge amount of current liabilities and the company does not have sufficient current assets to meet its current obligations. But the company has been able to maintain this position. See? So current investments जो है वो एक consistent है. यहाँ पे आके it has increased a lot. Trade receivables have always been a very small amount. Cash and bank balances has increased consistently, right? And it stands at a very high level today. Very, very high level today. Now, let us try to evaluate this working capital position because I don't think there is anything wrong with this. I don't think there is anything wrong with this. Reason, the current liabilities position has not increased substantially. It was 23, it became 29, it became 31, it became 38, it became 41, right? So it is increasing at a very nominal level. It's not that the company is facing any problem in meeting these current liabilities. Yes or no? Right? And let us see what is the position of this current liabilities vis-a-vis the purchases or the cost of goods sold. Let's look at that. So let us take is equal to sum of this divided by sum of, we should compare it with the expenses, right? These numbers. Yes or no? So this is 46%. So it is within a range. If I look at it for any 1 year, it might show some trouble to me. But if I'm looking at a 5-year period and it is within a range, that means this is how the company has negotiated from its creditors, isn't it? Yes or no? Are you understanding my point, sir?
Correct.
If this number was growing substantially, that means what do you understand when there is a cash crunch? The company is unable to pay to its creditors and is therefore struggling to pay them and is therefore either writing them off and creating a bad name for itself, or these numbers are keep getting increasing every year, right? But that's not happening. If that is not happening, that shows that it has got great credit terms from the suppliers. Thank you so much, Mr. Vishwanathan, right? Now let us try to justify this, or let us try to evaluate this further. We were just discussing about this period, right? So we have current ratio. Again, current ratio is simple. Quick ratio is simple. I'm not going into that. Let us look at this number. Debtors collection period. How much time does the company take to recover money from its debtors? Okay. This is given by average debtors divided by sales into 365. You will get this number in days. Okay. And how do you get this? Let's see. So your average debtors is what? This is your average debtors. Last year plus current year divided by 2. Okay. And your revenue from operations is this. Correct? That means how much time does it take for the company to recover money from its debtors? Right? And the answer is 1.84 days, or about 2 days. And this is again consistent. And we can understand this from the revenue model of the company. It has a pure cash sale model, isn't it? You don't go to Domino's Pizza and say, give me pizza today, I'll pay you after 1 month. You don't do that. It's a hardcore cash and carry business, precisely. So it's a pure cash model. On the other hand, look at the creditor's payment period. Okay, the creditor's payment period shows we take these two. We don't take changes. We should have taken changes in inventory also probably, right? And you take the trade payables together. Okay. What do you see? The company pays to its creditors after 170 days, almost 6 months. Now, I don't know what kind of creditors allow such kind of credit period, but that's how the company has been able to maintain. And by doing that, it has been able to operate despite having a negative working capital in a very, very good way. This has not impacted the value of the company at all. Okay. So now what do we conclude? Number one, we should not jump to a conclusion that negative working capital is bad. We must look at the business model of the company and then assess whether a negative working capital is good or bad. Number one. Number two, however, no company should continue to operate with a negative working capital in the long run. In the long run, it will be bad. Okay. Initially, it may be okay, but in the long run, the company must have positive working capital. If it doesn't, there will be a time when it will have to sell its long-term asset to pay off its creditors, because this number will keep on increasing. And we saw this was increasing. Right? So what the company did in the recent years, 2018 and 19, see the cash balance that it was maintaining was 3,000. Now 2018, it has significantly increased its cash balance from 3,000 to 48,000. Okay. And by doing this, it has not changed the operations at all. Look at it. Look at the position, right? The trade receivables continue to be at the same level. It's just that the cash balance has increased, and because of which the company's working capital is now positive. Where are we? Sorry. Yeah. Okay. So from negative, it has now become positive. Are we okay? Clear? Makes sense? And once we do the entire analysis of this company, we will see how has been the company's performance in history, I mean, in the past. Okay. We'll look at the 5-year performance of the company.
Mr. Goel.
Yes, sir.
You told that in the long run, keeping the negative working capital is not good. But if the company can manage with this negative capital, because nowadays in case of inventory, if they can manage with the just in time, even that if they can properly negotiate with the debtors, just in case of their nature of business is the retail, so they have no debtors kind of concept, or against that they can get a good bargaining with the buyers. So it's a good model, no? So how it becomes bad for the
Sir,
then it not unnecessarily
when we say in the long run, we assume that the company will keep on increasing, the revenues will keep on increasing. Accordingly, your work, your suppliers balance will keep on increasing. So increase may be very nominal, but it will increase. And when
they're keeping the they're maintaining in terms of percentage the same level, no, because they have the terms that as it shows the 6-month credit they have obtained, and they have been paying within 6 months. So because they have the sufficient flow of cash. It's not that company is suffering from cash crisis or all this kind of making loss. They're earning profit, so they're generating, and since there is no credit to the customers, so they have the cash flow, and they are utilizing rather this fund for some other business. I mean that if they keep it in the bank, they can earn interest.
No, correct, right? So when you keep it in the bank, when you're keeping in the bank, that is what this company has also done. Look at this. Look at these two rows, sir.
Yeah.
So when I'm saying that the company is continuing to make, it has not changed its strategy with respect to debtors and creditors. That remains the same. See, the collection period and the payments period is still in the same range. It has increased from, it is between 1 and 2, and it is between 160 and 170 only.
Correct.
So that has not changed. But the company has created a cushion with respect to its cash balance. See, reason
that is wrong. That is the easy job that you have not done. Whereas that a more tough job, that negotiating with the vendor, that they could continue to maintain at the level of 6 months. And also in the case of that recovery, they have maintained, they have done a good job. Whereas which is the most easy job is that funding, that keeping the fund in some profitable channel, that they have failed to do. So that is, I think, somehow what happened, I do not know on that context. Otherwise, so far the working capital management is concerned, they have been continuously doing well.
Precisely, that's what I'm saying. I am saying in the positive light of the company only. So we are on the same page.
Okay.
So it's important to create a cushion. That's what we are trying to say. So see, if you look at the non-cash working capital, that continues to be negative, and in fact, it is more negative right now. If you exclude cash from the working capital, you see this amount is very high. But so it is aggressively maintaining that relation with the suppliers to delay the payments, but in order to hedge its position from a liquidity standpoint, so that tomorrow if they have to pay, they should not have to sell a long-term asset. Therefore, they have created a higher cash inventory, a higher cash cushion with them. Okay. So from that perspective, I think Jubilant FoodWorks has done a great job in terms of managing its working capital. Are we all on the same page here?
Right, and effectively they have not used the cash to pay out dividends, but they have just used that to make the cushion.
Correct. So let's go further, right? The company does not have any debt, so we are not talking about debt equity ratio here. Net profit margin has increased from 4.74% to 9.14%, and it has consistently increased except in 2017, and we'll talk about that. Return on equity, same. So it was 15%, went down to 8, got up to 21.8, and is now at 27.3. So ROE is also constantly increasing. Again, remember, when you look at ROE, some people get confused here. So what should be the denominator? The denominator should be your average equity. Okay? You take the average of these two rather than just this year or last year's number. Okay? So return on equity would be given by, profit after tax divided by average equity. Return on capital employed is not relevant in this case because there is no long-term loan, and this difference is only because of the tax rates and so on. So we will not talk about that. Also, I have taken an average price. So again, I just took any random price during the year. So we've taken 628 in 2017. It was around 400 in 628 in 2016, 400 in 2017, 1275 in 2018, and 1345 in 2019. Approximate price. We've just taken any random price around the date at which the company reports its result, around June, July. Okay, we've taken that. So based on this, we saw the P ratio is 36.13, 39, 81, and 54. Okay? So you see, in this case, the company's P ratio has always been high. And it definitely shows that the company has been an outperformer in its industry. Correct? And I don't know what's the current price of Jubilant, but I think it's still very high. I think it's somewhere in 2,000 rupees range right now. Okay. We have the EPS also. So we've taken average. So we've taken the price earnings ratio. We've taken average price and the earnings per share. Now let us look at the business of the company. So we've talked about what business the company is in, right? We've talked about how it deals with its vendors and suppliers. Let us see what happened in 2017. So it's very important to understand, again, there can be n number of factors, but Jubilant FoodWorks operates what? We call it a QSR industry, isn't it? What is QSR? Quick Service Restaurant Industry. Current market price is 2380, correct? I think it's still a good company.
Yeah, good afternoon, sir. How are you? I'm good, sir. I'm good. How are you?
Yes, I am good.
Okay. Sir, actually,
Haji Sandeep, boliye. You were saying something?
Maybe not to us.
Okay. Possible. So look at the Domino's store. So again, what happens in case of quick service restaurant, right? The value that these companies derive from is the average order size, isn't it? What is the value of every order and how many people are ordering, correct? So typically speaking, more number of stores means more orders. And we also look at what is the average order size, right? What is the average value per order? For example, yesterday only I saw an ASSOCHAM's report which talked about the India's telecom industry situation, right? only number of stores or only number of users or number of subscribers does not mean anything, isn't it? Revenue is a function of number of units into price. Yes or no? So number of units could be number of stores, number of orders, number of subscribers, number of users, and so on. And then there is a pricing of that product. So let us look at Domino's. In 2015, it had 876 stores as of 31st March 2015. In 2016, it had 1026 stores. 2017, it had 1117. 2018, it had 1134. And 2019, 1227. So you see, this has been constantly increasing and steadily increasing, isn't it? And this is what is Domino's, Jubilant FoodWorks bread and butter, primarily. But it also started Dunkin' Donuts. And see what happened with Dunkin' Donuts. Started with 54 stores in 2015, went up to 71 stores. 2017 is when it realized that this is not going to work. Dunkin' Donuts does not have a great future in India. And it started downsizing the Dunkin' Donuts stores. It went down to 37 stores in 2018, and 2019 went down further to 31 stores. Right? Only 31 stores in 2019 in Dunkin' Donuts. And then it also started Hong's Kitchen in 2019. I don't know what has happened to that yet. But the main point, the crux of what I was trying to say is this. It realized in 2017 that it had a non-performing business, a not growing business, a cancer. And it decided to amputate it. In 2017, it decided that we will close the Dunkin' Donuts businesses. We will continue to operate the Domino's businesses, right? And if you see, the total number of stores is given to us. We have the total revenue. So look at the average revenue per store in rupees lakhs. 223, right? 219, went slightly down. 215, went down further, went up to 254, and currently stands at 280. Right? Average revenue per store, 2 crore 80 lakhs right now, across all formats. Across all formats. We did not have the information for Domino's and Hong's Kitchen and Dunkin' Donuts separately, so let's take it together. Right? So on one hand, look at this. This is constantly increasing. On the other hand, this has also increased. That shows that the company is fundamentally very strong, isn't it? There is no problem with the consumption story of Domino's in India. Even today, Domino's has continued to operate during COVID, has given a promise that there is absolute safety. Way back in April, it came up with a concept of no contact delivery, the first company in India to come up with a no contact delivery option, where the person will come to your doorstep, ring the bell, step aside, step behind, and stand behind, and will give you the pizza or whatever your order is, right? And everyone who's in the Domino's stores are keeping absolute food safety, right? So a flag bearer of food safety and contemporary food and beverage or dining in India, correct? So this further shows that even operationally, this company is very strong. Are we okay with this? Are we good? Any doubts so far? No? So we have done a very quick qualitative as well as quantitative analysis of Domino's. We have not done the management and this and that. We've just done a very surface level, scratched the surface of analysis. Now let us look at the valuation, right? Discounted cash flow. All of you have done discounted cash flow valuation already. Have you? Yeah? No, in the last 3 days, you've been taught about discounted cash flow.
Yes.
Yeah. So let us do a very quick
Thursday.
of discounted cash flows. Now, what we have done here, I will only do a very surface level calculation for your interest. So let's say we have calculated the free cash flow for the firm. Okay. I usually prefer free cash flow for the firm, though in this case, in case of Domino's, I could have gone with free cash flow to equity because the company does not have a debt. But nevertheless, we can still go with FCFF. So you start with, and I've done it historically for historical numbers. So you start with PAT. Okay. Simple. You take profit for the year. Okay. and you adjust it for exceptional items. Okay, remember we will only take the operating items. So we take PAT plus extraordinary item or exceptional items. You add back depreciation and non-cash expenses. Now remember, most people forget that you have to add back non-cash expenses also. Right? We only add back depreciation. If you can find out about the provisions and all of that, you need to add them as well. Okay? Every non-cash expenses have to be added back. Here we are only doing depreciation. So you add back depreciation. You take changes in you also reduce the capital expenditure. Now, where do you get capital expenditure from? From where do you get capital expenditure? Cash flow statement. Okay. Where in cash flow statement will you find capital expenditure?
Or the difference between the capital items up to years?
No, sir. If you are going for the cash flow statement, you don't have to look at the difference, right?
No, that's true. But alternatively,
yes.
So last year's.
So the first preference would be look at the cash flow statement, cash flow from investing items. That's absolutely right. And you don't take the total investing items. You take only the CWIP and PP&E. Any investment in capital work in progress, any investment in fixed assets. You typically take that. Okay, because remember, investing items can also be non-current or non-operating investments. So the company has just bought a land. That is not going to contribute towards your free cash flow. Okay, so you simply only take the property, plant and equipment and non-current items. Here we are taking, if you do not have the cash flow statement, then we look at this. Okay, now there can be more adjustment. I'm just doing a simplified adjustment. Ideally, you would take the changes in net block plus depreciation and also changes in CWIP. Okay. Sorry. Yeah, so you need to also add back depreciation here. Can someone explain why are we doing this? Can someone explain why are we doing this?
The depreciation is a non-cash expenditure, no? It has to be added back.
So here we are adding depreciation. I'm saying why here? Why in CAPEX? Because here we are only taking the net block.
Correct.
If you're taking the gross block, then I don't have to add back depreciation. But since the property, plant and equipment that is shown here, this is after depreciation. So therefore, you will have to add it back again. Okay, because here we are trying to only understand the CAPEX. So basically, you have to identify mathematically what is the amount of cash that is spent on investing activities or capital expenditure. Okay, so you take that number here. Next, you take the changes in non-cash working capital. So changes in non-cash working capital. So let us see here. So we already calculated non-cash working capital. You take the change of this. Okay, changes in non-cash working capital. So you adjust that. Finally, interest, you don't have any interest. So you get the free cash flow for both equity and lenders. Okay, so this is given by PAT plus depreciation, less CAPEX, less changes in non-cash working capital, add interest. So we see that we have got the free cash flow for each of these years. Okay, ideally, you will need to create the projections of free cash flows for the next 5 years. Right? When you're doing a full-fledged analysis, you will have to calculate the balance sheet and the P&L and accordingly calculate the free cash flow for every prospective year. Here, I'm not doing that only for simplicity purposes. We are saying that the growth rate in the next 5 years is 25%. And why am I taking 25%? Because look at this, right? The increase in free cash flow has been exorbitantly high in the last 3 years. So in the explicit forecast period, I am taking only a 25% increase in free cash flow over the next 5 years. Okay. Okay. Are we all okay with this? And then the terminal growth rate that I'm taking is where is 7.9%. Okay, we can take it 6%. We take a 6% terminal growth rate, which is here. From this, we calculate the terminal value. How do we calculate the terminal value? 6%, the terminal cash flow divided by KE minus G.
This 6% is just assumption, or it's like constant?
This is just assumption. These assumptions have to have basis. For example, the classic assumption with respect to terminal growth rate is that your terminal growth rate for a company can be 1 or 2% more than the average long-term inflation rate of the company, of the country. Okay. However, I am doing some research, and I believe that the terminal growth rate can be as high as 6, 7, 8%. But since currently, conventionally, we do not take anything more than 6%, I'm sticking to 6%. Okay. So basically, what are the assumptions behind the terminal growth rate? One say that in the long run, for an infinite period, what will be the growth rate of the company, right? There is an argument which says that the terminal growth rate should not be more than the GDP growth rate. Because if the terminal growth rate is more than the GDP growth rate, at some point the company may become bigger than the country. Okay, that is an assumption, or that is a premise. Now, I have my own arguments against that premise, but nevertheless, okay. So let's take 6% here. Cost of equity, I have taken 13.63%. How have I taken 13.63%? The free cash flow for the risk-free rate of return is taken at 6.07%. That's the risk-free rate as of 2019. I am calculating this as of 31st March 2019. And as of 31st March 2019, the risk-free rate was around 6.07%. How do you take the risk-free rate? You take it based on the 10-year government bond, which you can get from RBI's website. Okay. Currently, it is at around 6.13% this year. So 6.07% plus you have the Sensex return, market return minus the risk-free rate. As on 31st March 2019, the long-term Sensex return over a 40-year period, CAGR, was 15.4%. Okay, 15.5% is the long-term Sensex return. Minus the risk-free rate, and the beta of this company was 0.81. So on one hand, the company has very high growth rate. On the other hand, the company's beta is less than 1. That is, it is less risky than the market, historically speaking. So that makes it even more attractive. Okay. So based on that, our cost of equity came at 13.63. There is no debt in the company. So cost of equity and weighted average cost of capital is the same. Okay. So that is 13.63. So based on this, we calculated the terminal value. Okay. The terminal value is given by this value, that is terminal cash flow divided by KE minus G. Okay. Now, ideally, it could be either this divided by KE minus G, or I could say it would be this into 1 plus this divided by KE minus G. Okay. It would give me the same value. So in formula, sometimes you see 1 plus G. 1 plus G is when you're taking the last year's number. I have broken that part here. Are we okay with this? You all able to follow? Yeah. So this is my terminal value. I have to calculate the present value of the terminal cash flow. Remember, this value that you are getting is at the end of 5th year. Okay. This value that you are getting.
Please explain once again.
Yes, sir. I'll explain once again. So, in order to explain, let me put this value here. So, what I'm saying is, this is my free cash flow at the end of 5th year. Now, 5th year is my explicit forecast period, right? After the explicit forecast period, I have to see what is the value of the infinite period. So for infinite period, I simply have to assume that this 132,611 will grow at the rate of 6% forever, and I will have to discount its value to arrive at the present value at the end of 5th year here. Okay, so one way of doing this is 5th year's cash flow into 1 plus 6% divided by KE minus G or WACC minus G. I have just broken this part here. Okay, this value is the same. See, are we okay, sir? इसको ऐसे ही कर लीजिए, छोड़िए. Oh, sorry.
Is this the valuation of company?
No, sir. This is the value of the infinite period. This value is the value of the infinite period. Now you discount it further to bring it at today's value. So this becomes the value of the company, enterprise value. Okay, you take a sum of this. Okay. Are we all okay? Following together? Yeah. Now remember, this is enterprise value. If there is any debt, you have to reduce it. You have to add the cash also. So what you get is the value of equity. In fact, you have to add one more thing here. You don't know. Okay. This is how you would get the value of equity of the company. Are we all okay with this? Yes. I'm not.
Can you please elaborate this portion, value of equity, calculation of value of equity?
What we're doing here is we got the present value of the cash flows. We got the present value of the terminal cash flow.
Yeah.
You add all them up. What you get is the enterprise value. Now, enterprise value is the value of the entire company, including debt. Okay. So in order to arrive at the value of equity, you need to reduce the value of debt. So you reduce it. Now, why do you need to add back cash? The free cash flow calculation assumes that you are doing this valuation to get the control of the company. The entire company will become yours. Okay. So when the entire company becomes yours, what would you be doing? You would be paying this much value. Yes or no? You would be paying 1,264,867.35. You would be paying this value to get the entire company. Correct? But when you're getting the entire company, you are also getting this cash. Yes or no?
So this cash will not become a part of all the projected future cash flows.
No. The cash has already been factored into.
Okay.
That is all free cash flow only. Try to understand. Let's look at this number, enterprise value. What we are saying is enterprise value, this value 1,264, whatever value is getting there, is the total amount of money that one would have to pay to get the full company. If you have to buy 100% stake in the company, how much money would you pay? This amount. When you pay this amount, the entire company becomes yours. Correct? Correct? So when the entire company becomes yours, you also get this cash back to you, isn't it?
Yes.
Right? So this money comes back. So now, what is the value of this company? 1,264 plus 48905. Because the value that will be remaining with you is the full amount that you paid plus this. So therefore, you add it back. Basically, you add the cash back. So this becomes the overall value of the company. Okay? यहाँ पे, so this becomes the value of equity divided by the number of shares. You get value per share 999.52.
So is it the always that is happen that the difference between the value of equity and...
Sorry, sir, say that again. Your voice is cracking. Hello?
Only cash makes the difference between the value of equity and the value of the firm?
No, sir. Debt. So in this case, there was no debt, therefore we have not taken.
Okay. So debt is another factor. The debt is to be deducted then in that event.
And yet another factor is value of non-operating assets. Remember that whenever we are calculating the free cash flow, we are only worried about the operating assets of the company.
Okay.
Right? If the company had, let's say the company has a land which is kept in investment.
Yeah.
The value of that land is 100 crores. But that is only lying in the investment of the company and it is just there. So that 100 crore had no impact in our valuation, isn't it?
Okay.
It was not taken into account because it was a non-operating asset. So you add that value also. If you heard the news of IPO of LIC, Life Insurance Corporation was planning to come up with an IPO, isn't it?
Yeah.
The entire IPO has been deferred by a year only because of valuation. Why? Because you can appoint actuaries to value the LIC's business. Right? The insurance business can be valued sitting on the desk.
Yeah.
But LIC has got huge land banks.
Land
and
buildings.
a valuer has not been appointed yet to value that land. So even if they are appointed today, it will take 6 to 8 months to value that land.
Let us pass the exam, we will do the valuation.
Yes, sir, sorry.
So
Let us pass the exam, we will do the valuation.
Do it fast.
Hello?
Yes, sir.
Can you share the sheet also this?
Aji?
Hello? Can you share this sheet also?
Yes, I will share, sir. I will share it. Yes.
Yeah, how you calculating this value of equity and value of equity? The number of share is sorry.
Number of
1319.
Number of share is given in the balance sheet, na? We have equity share capital, right? Divided by face value will give you the number of shares. Sorry, here 1319.6 lakhs. Are we okay, sir? Okay, Anilji?
Yes.
So this becomes the value of the company on a as per DCF method. Now again, see, we have done this without any management interference, without any management query, purely based on Excel, right? So this becomes the value of the company. Now this value is not very high. It is only 999 and the current value is 2380. Okay, but let's hold on. Let us go further. We can take so this is the DCF valuation. Let us look at the relative valuation right now. Okay, let me hide these columns for you. What is the industry PE ratio? If it is assumed to be 50, we saw the PE ratio of this company was 54, right? Yes or no? What was the PE ratio of this company? 55. Correct? So if you take the PE multiple of 55, what becomes the value of the company? See, 1681. Correct? Projected profit. What we have done, whatever the profit of the company was, increase it by the expected increase in profits. 25%. So with this, your value per share as per PE multiple comes to 1681 as of 31st March 2019. Okay. First method DCF value comes 995. Second method PE multiple value comes 1681. Okay. Third multiple, price to sales multiple. Assume that this is 4.5. Projected sales, again, we are assuming the sales will increase by 18%, let's say.
In the first calculation, this projected profit is profit after tax, PAT.
Yes. Second is projected sales, 18%. We are taking an 18% increase in profit. What happens? The value comes 1420. Okay. These are all our assumptions, so don't worry. I mean, some of these may be wrong, or some of you may not agree to all of them. Third, we take industry EV to EBITDA multiple, 28. Correct? So company's EBITDA is 64675. Enterprise value. So what you get is with EV to EBITDA multiple is EV is what? Enterprise value. So enterprise value to EBITDA multiple we are assuming at 28. So based on this, you will get enterprise value 1810901. Less debt, add cash. You get value of 1409 per share. This is number of shares. Okay. This is value per share. So you simply take the average under all the approaches. The value that you get is 1376. Again, you can always dispute these numbers. I'm only sharing approaches with you. Okay. Abhi, are we okay with this so far? Yeah. Let us see what happened to the company's actual position. Right? What was the company's actual position? Give me a second.
Sir, how many years you are considering for valuation of the firm?
Sir, usually we take not less than 5 years. So this is just an academic example. So I have not actually projected the financial statements. I have taken 5 years plus terminal value.
5 years, you are based on the profit, you are calculating based on the weighted cost of capital.
This portion, yes. DCF method, I am doing 5 years projections. This I am just taking 1 year forward expected projected profit in 2020. Projected sales 2020. Okay. Now let me show you what happened to the company's share price actually. Can you see Jubilant FoodWorks graph?
Yes.
Yes. We had our numbers from 2015, right? Yes or no? Our numbers were from 2015. Whatever I have explained so far, I need to justify that, isn't it? So let us try to see. Let us look at the where is it gone? ROE kahan gaya? Return on equity. Okay. So 2016 it was 15.3%. 2017 the stock should have taken a dip, isn't it? The profit went down, the number of stores went down, average revenue per store went down. Correct? So see what happened. The company had its lowest price in January 17, third quarter. The moment the company came up with its third quarter result, the stock price tanked to 392. Okay. But after that, as the company's performance has improved, the share price has constantly improved. In our calculation, we saw the average price of around 1400, isn't it? In March 2019, our average price came at around 1400, right? 1376, 1400, this was a ballpark number. So in March 19, see what was the price? Around 1300, 1400, yes or no? This is where the price hovered around. Are you all with me?
Yes.
Yes. We have not factored in 2020's numbers. Maybe the 2020's number can lead to an even better picture. Possibly. Are we okay? Are we all okay, sir? Got it? Yeah. So financial statement analysis, qualitative analysis, understanding the company's business model, and trust me, we've taken less than 2 hours to evaluate a full company, right? This is not how fast we do it in real life. Of course, there's a lot more that goes into it, but it's important to look at the details, do a due diligence, understand the business model, crunch the numbers, infer things out of it, and not only going by the books, right? We have to understand the real value, right? And again, trust me, I have not even gone into the details of the annual report of the company. We have not done this valuation in real life. I've only done this for academic purposes, right? If we do it in real life, probably it is possible that the value of the company may be 2,500, and we might say that, hey, this is a good buy even today. I don't know if it is, right? But it appears that fundamentally this company is very good. But yes, even for a good company, we will always look at the PE multiple. So if a PE multiple exceeds 55, 60, we always say that, hey, let's hold on to it, because understand that valuation is not a trading business, right? Valuation is more of an investment thing. So you have to look at it from the long-term perspective, right? You don't do this valuation when you want to trade in the stock. You just don't. Okay. Are we good, sir? Any thoughts, any questions? I think I'm right on time, and I'm standing between you and your lunch.
No, that means the valuation professional can make money from the stock markets.
I can never say that, sir.
Can you, sir, share with your mail ID or your WhatsApp number so that in future, any doubts come up, we can remain in touch with you?
Definitely, sir. I will definitely share all of that with you. I am there with you tomorrow and the day after also, right?
Sure.
I will share this presentation, this Excel file both, and yeah, I will share my contact credentials also. And meanwhile, yeah, so let me just type it here.
Mr. Our sir, I also belong from Kolkata. So both guys, you are belong from Kolkata.
Sorry, who? Who else?
He is from Kolkata.
Yes. I think many of you are from Kolkata. Who else is from Kolkata here? Saurav Chaudhary is from Kolkata.
Yes, I am from.
Suhani is from Kolkata. I know Suhani, yes.
I am from Kolkata.
Yeah, okay. Great. Thank you very much. I think that's all I have. I have already mentioned